Joe has outlined the basic structure of what it is that we do in the market. Our objective is to buy a good stock, to look at that stock like a piece of rental property, an income generating asset, and we're going to make our money through selling covered calls against that stock to generate the cash flow. So it's a really important distinction. We're not buying a stock with the hope that it goes up. We're buying a stock and we're renting it out for that 3 to 6% per month cash flow, regardless of which way the stock price goes, because the cash flow is what's going to grow our money. And the cash flow we can get consistently regardless of what the market does. We can't pick the direction of the market because we're not in control of that. But the cash flow we can control. And the only way that you can generate cash flow consistently off your investments is through our covered call technique. And that's what we're going to start talking about now. So first of all, an introduction to options. A lot of people in here never used an option before, right? Yep. Okay, so this section is we're going to talk about what an option is, how the pricing of an option works, what strike prices and expirations are. So if you have any questions based on any of the topics that I'm presenting, please let me know and I'll address your question before we move on. All right, so what is an option? An option is a financial instrument and contract between two parties. In an option transaction, you have a buyer of that option who is a speculator or a trader. Whenever you purchase an option, whenever you buy an option, you are a speculator or a trader. You are gambling on the direction of the market using an option contract. Then the second party in this trade is the seller of the option. And that's what you're doing when you're selling covered calls. You're actually not speculating with the option, which is extremely high risk, and the vast majority of speculators lose over the long term. You're actually selling the option contract to the speculator. So you're doing the complete opposite than speculation. A call option gives the buyer of that option the right, but not the obligation, to buy a stock at a set price up to a set date. So the purchaser, the buyer of that option, buys those rights. The buyer of that option does not have to exercise the option to buy or sell the stock if it's not in his or her favour to do so. Okay, what's really interesting about option markets and where they differ from the stock market is that the option market is a zero-sum game. Okay, in the stock market, wealth builds and generates through time as the value of companies increase. The option market doesn't work that way. In the option market, money goes into the market at the start of the month, and the same amount of money to the penny is going to leave the market at the end of the month. Okay, so the wealth is distributed between the buyers and the sellers, right? Money goes into the market at the start of the month, money goes out exactly the same amount to the penny at the end of the month. What we do know statistically at the Chicago Board of Options Exchange, which is the listing body for option contracts, like the New York Stock Exchange is for stocks, 80% of option contracts are going to expire worthless each month over the long term. So the vast majority of speculators actually lose money over the long term. Okay, so when we look at this over here, when an option contract expires worthless, which they do 80% of the time, the buyer of that option contract is going to lose his investment in that contract. And we know that 80% of the buyers actually lose money. So where does that money go? This is a zero-sum game. That premium goes into the pocket of the people who are selling covered calls, one, and it goes into the pocket of the market makers, two. This has nothing to do with high-risk option trading. If you're a speculative investor, if you want to take $10,000 and turn it into $50,000 overnight, that's gambling and trading and speculating, and that's not what we do. You're going to find out of a group of people, if there are 300 people sitting in this room, you have a group of people speculating, maybe 20 of them are going to make money and the rest of them are going to lose money. So what we're here to talk about is a technique that you can apply to produce consistent, achievable returns every month. Okay, exchange-traded stock options have standardized characteristics. These options that we deal in are traded on the market just like stocks. Okay, people are buying and selling stocks minute by minute, day by day. People are buying and selling option contracts on those stocks minute by minute, day by day, same thing. And let's look at an example of a standardized option contract. This here is the JP Morgan $30 September 2008 call. And this is the standard way that an option is described. Another example would be a General Electric $25 January 2009 call. Okay, so every option has those characteristics. And this particular option relates to stock in JP Morgan, has a strike or exercise price of $30, an expiration date of September 2008, and the option type is a call. So if you own that option, you're going to have the right, but not the obligation, to buy JP Morgan stock at a price of $30 up to the expiration date of September 2008. Okay, this is an example of a normal options trade. What we're going to talk about here initially is the speculative use of options, right? Remember, they're the buyers of an option, who is a speculator, and then the seller of an option, who sells a covered call. We're going to talk about the speculative use of an option here. Why this is important is because this is not what we do, but this is how we make our money. We make our money from the people who are gambling in the market, who statistically 80% of them will lose their money over the long term. So options are used by speculators to bet on the direction of a stock or a market. Let's say our speculator has a hunch. He thinks JP Morgan stock is going to increase from its current price of $29.50 a share. The speculator decides to buy a $30 September 2008 call for $1 per share. That $1 per share is the per share price of the option. Okay? Each option contract relates to 100 shares. So if he bought one option contract at $1 per share, he would have invested $100 in this trade, right? The speculator now has the right, but not the obligation, to buy JP Morgan stock at a price of $30 up until the expiration date of September 2008. Now, these option contracts are standardized and they all expire on the third Friday of each month. So this contract is going to expire on the third Friday of September 08.
Third month or third week?
The third Friday. The third Friday of each month. Yep. The speculator wants, why he purchases this option, the speculator wants the stock to rise so he can exercise his right to buy at 30 and then immediately sell the stock in the market at a higher price for a profit. Okay, so when a speculator buys this option, he is anticipating the stock price is going to increase. So let's say that's...
So he's gambling.
So he is speculating. He is gambling. He is relying on the market going up to make money. So let's say that scenario plays out and he has picked the direction of the market correctly and the stock has gone up from $29.50 up to $35. The speculator can exercise their option, which they can do at any time, and buy JP Morgan stock for $30, then immediately sell the stock in the market at $35. So he's got a significant profit opportunity there, right? Yep. Speculator's profit on this trade will be as follows. He has exercised his right to buy the stock at 30. He's bought it at 30. He then turned around and sold the stock at the current market price, which is $35. So he's made $5 a share here. And the option cost him $1 per share at the start of the month or the start of the period whenever he invested in the option. So he ends up with a profit of $4 a share. Now, if he bought one contract, he would have invested $100, right? Because each contract relates to 100 shares. So he would have invested $100 here and he will come out with a profit of $400. So what's important there is not that, but what's important is that's a 400% return on capital, right? If he put 100 grand on the trade, he's made a profit of $400,000. Okay, so that's the leverage. That's the reason that a speculator buys an option contract. The stock has only gone up by about $5, small increase in the stock price, but the speculator has made a 400% return on capital. 90%, 95% of the market are speculators. Okay, they're not doing covered calls. 90 to 95% of the market are trading options. That's what they're trying to do. They're trying to turn a small amount of money into a large amount of money overnight. And that's all good and well if the stock price goes in the direction that they anticipated. But what happens if the stock price goes down rather than up? Remember, the speculator bought the option contract and they were anticipating the stock to go up. So what happens if it goes down? The exercise price of that call was $30 per share. If the stock price is less than $30 on the day of expiration, third Friday of September 2008 in this example, the speculator will not exercise that contract as they can buy the stock cheaper in the market. So let's say the stock's $28 on that day of expiration. He doesn't want to exercise his right to buy the stock at 30, does he? He doesn't want to buy the stock at 30 when it's only 28 in the market. So the option contract will lapse, it'll expire worthless. When the contract expires worthless, he's going to lose that $1 per share that he paid for the option contract. So in this case, he only bought one contract, so he's lost $100. But if you put 100 grand on the trade, he's lost 100 grand. Okay, so it's a 100% loss of capital. So that's the downside of that speculative trade. And statistically, 80% of option contracts, and they're not our statistics, that's the Chicago Board of Options Exchange, 80% of option contracts are going to expire worthless every month. Okay? So the odds are very severely stacked against them. 80% of speculators will lose their money over the long term. With those odds, you might ask yourself, well, why would anyone go and trade options? Why would anyone play that game when the odds are so severely stacked against them? Well, it's the same reason that people flow into Las Vegas, more people every year, and more the casinos and the houses get bigger, and more money gets lost in the casinos year after year after year, is because people love to gamble. It's very enticing to everyone to stick 10 grand into the market and have it worth 50 in a week, right? But over the long term, the vast majority of speculators, 80% of them lose money trading the market.